In this video, I'm going to share 5 wealth building strategies that you can use in your 50s. Hi, I'm Camille Gaines here, and on my website, retirecertain.com, I write about and talk about my investing ventures since I bought my very first Fidelity mutual fund about 40 years ago. And also my income stream adventure along with my husband Larry over the past 15 years or so after we stumbled into early retirement and decided that we did not want to make retirement withdrawals, and we didn't want to cut our expenses in retirement, and we didn't want to make other lifestyle changes that would have been required at the time. All right, in this video, I'm going to share with you 5 wealth building strategies that we discovered on our income stream and wealth building adventure a little bit later in life. The very first thing that we learned is to take calculated risk. It's really easy when you're working and you have the nice salary coming in to invest and to not worry so much about it, right? Because you've got that salary coming in. But when retirement happens, or you become an entrepreneur perhaps, or you no longer have that steady employment check coming in, or transfer coming in, I should say, these days, then it gets a little bit harder to invest, because you know that if you lose money, number one, you don't have the salary coming in to make it up, to save that money, more money, and also because you don't have the years to passively invest in stocks and bonds to recover that money. So it can be really, really tempting to not invest. So it's super important, I found, to invest, but based on calculated risk. So what I did to deal with this, and my husband and I sort of divide and conquer these various tasks. So I'm sort of in charge of the investing of our core portfolio. And what I did is I became a more tactical investor using ETF strategies that are defensive in nature, but they also have more predictable and less risk than if I was based in something that's just simply a long-term passive buy and hold investment strategy. So take calculated risk, because we can't afford not to invest, because when we don't invest, even though it feels safer, we're losing money every year to inflation, because inflation depletes the value of our capital every single year, almost every single year. And because we're missing out on opportunities to grow our money, even though it feels safer, we've got to keep investing even though we're older. The next tip is to invest in assets other than stocks and bonds, or at least consider them. When you just invest in stocks and bonds, I like to equate it to buying a car without any tires on it. We've got the car, right? It's a great foundation piece. But when we put the tires on, the car can really go. It can go faster, and it can do other things and go to all kinds of places. So what we learned after we stumbled into early retirement was to not just focus on stocks and bonds. We started investing in alternative investments that would generate income for us, so we wouldn't have to rely on retirement withdrawals. So I want to point out, need to look at my notes for this, but even though the stock market was the best performing asset from 2010 to 2020, in general, we had other years that other assets were doing better. Now, we've looked at real estate, or invested in local real estate rentals, and even a couple of oil partnerships and other alternative investments as well. But even if we just look at slightly alternative investments besides stocks and bonds, I just call them slightly alternative, because we can still buy them in just like we would buy stocks. But for example, let me look at my notes here. In 2001, 2004, 2006, 2010, 12, and 2014, REITs outperformed. They were the highest, they had the highest growth rate of 10 different major asset classes in all those years. So they outperformed stocks. So even though people think of stocks as being the only investment, there have been many other years that REITs have outperformed stocks. Other investments, commodities, have had years that they outperform stocks. Gold has had years that they outperform stocks. So again, let me tell you all these years that REITs did better. 2001, 2004, 2006, 2010, 12, and 14. REITs outperformed. They had a higher growth rate that year than stocks did. And just as a refresher, REITs are real estate investment trusts. They're purchased just like stocks on the market when you log into your brokerage account and buy a REIT, as easy as it is to buy a stock, but they're invested in real estate. My point that I want to make here is don't just think about stocks and bonds as being the answer to you having enough money to live how you want the rest of your life. Think of that car without tires on it and think of adding those tires and all the places you can go and how much faster you can go and different you can go if you put those tires in the car. If you look at other assets besides just stocks and bonds, not only that, with those tires on, your car can drive you to someplace that's safer, right? We may need safety going forward as the things change. I don't want to be a doom and gloomer. Things change from the way they have been over the last decade or two, and we no longer have that performance that we've had in stocks and bonds. There is the most fantastic visual tool that has all the different asset classes, like I was talking about, like REITs and commodities and gold and large U.S. stocks and small U.S. stocks and international bonds and all these different colors plotted on this fantastic visual tool. I'll put a link to it in my article, or I've got a link to it in my article entitled "What Goes Up When Stocks Go Down." So you can check that out at my website, or if you just Google "What Goes Up When Stocks Go Down," you'll see my website, retirecertain.com. There's a bunch of ads at the top first, I'm sure, and then there may be another article or two or three, but you should see me on that front page, retirecertain.com. What goes up when stocks go down? And I've got a link. Scroll down to the bottom of that article, and I'll try to remember to put it in the description. But it's a fantastic visual tool so you can see how all these different 10 asset classes performed in different years. And it's, as my dad would have said, it's an eye-opening experience. You'll be able to go, wow, I am missing out if I don't consider other investments besides just stocks and bonds. So make sure you check that out. The next tip is to use capital strategically and optimally. Sort of touching on that last point of not just selling for stocks and bonds, but also not just selling for minuscule returns or average returns or below average returns because we're trying to protect our capital. Use that capital optimally. And what I like to do, one thing I share it with my clients, is I have a spreadsheet where I have all of our capital and I have what kind of return that it's getting. And I open that up and it's tied into my net worth statement, another tab at the bottom. But what I like to do is just brainstorm, just open that tab up and look at the returns we're getting and plan going forward, see what kind of returns I might be able to get that are better than what I'm getting. I'm saying, are we optimally using this capital? Do we have too much money tied up in home equity, for example? Do we have too much money tied up in real estate, since we do own both our home and real estate rental properties? Do we have too much capital tied up in stocks because we do have a defensive stock and bond portfolio that's tactical in nature? Are we getting the best return that we can from our capital? Should we look at using some of this capital to buy a small business? And that's one thing I've been looking at lately. Yes, I think we should. So I've been actively looking for that. But if I didn't specifically look at the spreadsheet and ask myself this question, I wouldn't have that idea. This is what wealthy people do as well. I've got this strategy in my 25 strategies the wealthy really use that you can use too. So check that out. It's free on my website as of this recording. So feel free to grab that at retirecertain.com. The next strategy or tip I want to share with you is to have a knowing that if other people have done this, created wealth, enormously so, right? We can do it too. It's so easy to get caught up in the mainstream thinking that we can probably retire if we cut back our expenses, if we maximize Social Security perfectly, if we don't make retirement withdrawals that are too high. What a way to live and think in the years that we finally have time to do the things we've always wanted to do. No thanks. We can look at other people and see that they've done it, they've reached their goals, they've reached beyond, exceeded what I could ever imagine doing, but they've exceeded beyond the norm and what was expected. For example, Edison had 1,000 patents before he actually was successful. Abraham Lincoln actually had failed businesses. The Dr. Seuss books were rejected by 27 publishers before they were finally published. We just have to think differently and try differently. Look at Dave Ramsey, who lost money based on his story from real estate. He bought too much real estate. He became over leveraged. He lost all of his money, and that's what led him to create the debt reduction program that has since gone on to turn him into, I'm sure, I don't know what his net worth is, but I'm sure multi-millions, I'm guessing. So think bigger and think beyond just the mainstream and what we're taught to believe when we listen to the limitations that are put on us, or don't buy into that thinking, that limited thinking, and think that that's the only option available. Because if we look at other people that have done differently, it discredits the fact that we can't do it because other people have done it as, also. We can even look at kids now. There was a girl in my son's middle school who has started a YouTube channel. My gosh, she was flying to Paris to meet with L'Oreal. She's in the mid-20s. She's making so much money. This is doable. We can do this as well, even though we're older, or more so because we're older, because we have wisdom and experience. The next tip is to buy assets that pay for themselves. For example, many small businesses that I've looked at lately, I mentioned I'm looking at small businesses that are not expensive, are paying for themselves from cash flow. They would pay for themselves should I choose to finance the small business, which I may do. Another example is our rental properties, which we purchase and we finance a large portion of those properties. But the income that we get from those properties not only pays for the financing, it produces a small cash flow, positive cash flow for us. These are assets that pay for themselves. If you're in your 50s or late 40s, it's not too late to do this. If you purchase assets that pay for themselves, you will own those assets without debt on them. And even if they are not yet debt-free and you're already retired, this will come to fruition if you stay healthy and live a long life, as we all hope to do. So think about, how can I buy assets that will pay for themselves over time and generate cash flow and or increase in value, perhaps even some good tax benefits as well. That's what I wanted to share with you in this video. Remember, retire certain.